CIO-Equities at Tata Mutual Fund to take some questions. Rahul, good to have you with us here. Thank you very much. The market has been grinding higher, Rahul, and usually we've seen this late into the year, before the end of the calendar year, trends don't change meaningfully, right? I mean, you don't start something new. What should we expect near to slightly medium term?
Yeah, I won't bet on that kind of seasonality just because past it has not happened. But yeah, you're right. I think what we are seeing is that the tug of war between good domestic fundamentals in terms of the cyclical recovery in various sectors and not so great global macros continues. And what we are seeing is just a culmination of that right now. I think Indian fundamentals or the economic fundamentals in terms of the banking sector, capex cycle, etc., seems to be pulling its weight much more than what the global macros can pull it down with. But at the same time, these are uncertain times in terms of which way the interest rates will go. I think market might be taking a call a bit too soon that we will get a pivot. Maybe not. Maybe the interest rates will stay higher for longer. So all those questions, I think, as we enter into 2023, in the first 3 to 6 months, it will become much clearer. So I won't be surprised if we stay in this kind of a market, a bit of a range-bound market with volatility, which is actually not a bad outcome given that the global macros remain still very, very uncertain.
Okay, so range-bound market and global macros are uncertain, but that's not stopping a couple of sectors in our own market. Just take a look at the banks. Bank of Baroda, Bank of India at fresh 52-week highs. In fact, Bank of India is now up almost 3.5%. Bank of Baroda sitting at a fresh 52-week high. It's more than doubled this year. So, that's the question, right? Rahul, if we do see a range-bound move in the market, do you reckon that some of these sectors like banks could continue to outperform? The management of J&K Bank was very confident about a 16 to 18% loan growth. What's your pick of the pack here? And do you see more upsides?
Well, absolutely. I think in a range-bound market, there are much bigger and clearer opportunities for certain sectors and certain kind of stocks to do well. What we are clearly seeing is that value and GARP as a philosophy is tending to do better as we enter into this higher interest rate regime. So even if index remains flat, we will continue to see that outperformance continue. And secondly, like you mentioned about banks, the cyclical recovery in terms of the earnings, where we are seeing everything coming together nicely, whether it's credit growth, the NIMs going up, and the credit costs coming down. You couldn't ask for more. And some of the banks are available at early to mid-cycle valuations, not their full valuations or not their full valuations in the last upcycle. So I think there is room to go. Obviously, I can't comment on stocks, but as a sector, there is definitely valuation comfort, and there is also the earnings comfort over the next 1 to 2 years.
Rahul, what about the auto space? There were some positives that we were looking forward to. Some of them are playing out, but the index itself has been underperforming. If I take a look at the last few weeks, the second half of the year should look up. Demand is good. Input costs are cooling off. Supply side issues as well are getting resolved. Your pick of the pack?
So autos, yes, I think, but it's not as clear as banks. It's not moving in tandem. Let's face it that autos is not just one homogeneous sector. And let's start with that and then drill down into two-wheelers, four-wheelers, CVs and tractors. So the last two I mentioned, CVs and tractors, things are a little bit more clearer in terms of the structural drivers of the top-line growth. It is not as clear in the two-wheelers and the four-wheelers, and it becomes then a question of how much you are competing with EVs, what is the competition shaping up as, especially in four-wheelers. So it becomes a little bit of mixed and stock-specific call in two-wheelers and four-wheelers, whereas CVs and tractors, there seems to be more, let's say, macro tailwinds behind these two sectors. So there really you have to break down autos into multiple subparts, and it is not as homogeneous as an IT services or a banking sector would be.
What about some of these so-called trending sectors? I mean, I do know that there is some legitimate reason why, you know, these defense stocks, etc., are rallying. Orders have been coming in and there's a lot of focus from the government. But these are sectors that have this big move and then suddenly fizzle off. You think the best of the rally is done here in pockets like defense?
A large part of the re-rating is done, but the re-rating has been for good reasons and for real reasons. I mean, we are seeing that indigenization is not just a term, it is actually happening, and localization is actually happening. So there is focus. Some of the results of these efforts will take 3, 5, 7 years to show up in numbers. So to that extent, a large part of the undervaluation which was there in these stocks have played out. From here on now, it's a question of just tracking, making sure that each of these individual companies which have done well in the defense sector, how well they execute, whether the government policy sustains. I think it will, but we need to keep a track on that. And then the valuations will continue to be justified, and you will get returns in line with maybe the earnings growth. But as I mentioned, the large part of the re-rating or the realization that there is potential in this sector, that realization, when it comes there, the undervaluation goes away. I think that is something which is behind us now.
All right, Rahul, the other debate that's going on is, have these new age themes bottomed enough? While having a look at some of these themes, you have a few of them, a handful of them, 4, 5 of them that are listed. Some of them looking exciting.
Again, these are all very, very different companies. Let's not club them together. And obviously, we are, the valuations have come down to levels where, they are probably only 2x the value which were there in terms of the pre-COVID valuation. So yes, there seems to be some amount of reality check, and the valuation sensibilities have returned in this sector. So yes, we would look at it, but again, as I mentioned, we should not look at it as a pack. Each company has a very, very different business model, very different dynamics, very different ownerships in terms of the private equity. So we will have to take a call taking all these factors into account. And again, let's not forget that the interest rate scenario globally is also challenging for some of these stocks and the valuations to sustain. So it's a very complicated, lot of moving parts in these stocks still, in my view.
Okay, by the way, the market is now falling further, so do keep an eye out on that. The Nifty is now down over 100 points. And remember, the 20-day moving average on the Nifty is 18,417. So we're holding on to that for now. So that seems to be a bit of a support for the market. But for now, it's not looking that great. Rahul, since it is the end of the year, as we head into December 15th, people start to sort of go on leave and there's festivities. Just wanted to wish you a very happy New Year in advance. And it is our 23rd anniversary as well here at CNBC-TV18. So what would your view be or wish be for all the retail investors who've watched you over the years? What's the kind of market outlook for the new year? What's the asset allocation strategy that you have?
Well, first of all, congratulations, and wish all of you and all the viewers also a happy New Year in advance. So my advice for next year would be to keep a focus on asset allocation between debt and equity. Debt is now also offering reasonable yields. Within equity, I think it has to be a combination of some of the dynamic asset allocation products we have, which will see you through this volatility of the next 6 to 9 months. But at the same time, I think there is alpha to be made in value funds. There is alpha to be made in some of the sector funds we talked about, banking and potentially infrastructure. So a good combination of asset allocation and alpha generating products or alpha generating ideas, I think, will be the name of the game next year. Thank you.
Okay, all right, Rahul, thanks so much for stopping by and filling us in with your thoughts, as well as thank you for your pleasant wishes as well. Well, let's move on.